Hello, everyone. I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can focus on creating a bigger impact. Today, I want to dive into the fundamentals of nonprofit accounting as it relates to net assets. Understanding net assets is essential in our effective financial planning, regulatory compliance, and fostering of transparency with donors. By the end of the session, you'll have a clear understanding of what net assets are, the types of net assets you may encounter, how to account for them, and their significance in the financial statements. Well, there are two types of net assets. And I just want to say that net assets are just basically the difference between our assets and our liabilities. In the for-profit world, this would be our equity section, but there's no ownership, so we call it net assets. And there are two types. One type is without donor restriction, and the other type is with donor restriction. So I want to break those down for you. Let's address the without donor restriction first. These are things that we refer to as unrestricted funds. They're flexible and can be used at your discretion. They come from general donations, program revenue, unrestricted grants, and they give the organization room to cover their operational expenses and strategic initiatives. Now, net assets with donor restrictions come to the organization from a donor that has restrictions based upon specific conditions. Those conditions could be time related. You have to spend this within a certain amount of time or a specific period. Or they could be purpose restricted, earmarked for a particular program or project. Or they might be for an endowment, which means that the funds have to be held permanently and the income can be used for the donor's discretion, whatever the donor has set up, whether that be for operations or for a specific program. That's up to the donor to set those parameters. And this is where we want to get into a little bit about having a gift acceptance policy. What are you willing to accept? So please make sure you have those in place as well. It all works together. Now, when we're accounting for our net assets, it's really important that we're keeping track of what's restricted and what's not restricted. This is crucial so that we are ensuring that we're respecting those donor restrictions and their wishes, and we're staying aligned with our organization's mission and our needs. What happens when we receive a restricted donation or any type of contribution to our organization? We have to decide if this is with or without donor restriction. Now, revenue is recorded based upon its natural restriction or lack of restriction. So if it's unrestricted, we're going to be able to use that for our operations and programs in general. If it's restricted, generally, like we said, they're restricted for a specific purpose or for a specific time period. And as we meet those restrictions, we are allowed to release the funds from restriction. As we incur expenses that are related to a specific time frame or a specific program, those restricted funds get released into the unrestricted pot of money. And we need to account for these changes, these moves. The restriction balance increases from restricted donations and decreases as we meet those restrictions. So I want to talk about the financial statements. We've got several key parts of financial statements that the net assets and donations with restrictions affect. The first one, of course, is a statement of financial position. That's the nonprofit equivalent of a balance sheet. And the net asset section, like I said, is the difference between our assets and our liabilities. It's this third and final section on that report, and it's divided into the two categories. Guess what? Without donor restriction and with donor restriction. Now, our without donor restriction encompasses our operations and our board designations, while our with donor restrictions encompasses those donations that have a time restriction, a purpose restriction, or therefore an endowment, and they're permanently restricted. Our statement of activities, which some like to call an income statement, shows the changes over time. So as funds come in, we get to, are we increasing those revenue accounts with or without restriction or contribution revenue, and then spending the money over a certain time period. So we're going to be breaking down the income and expenses according to the types of restrictions. So you're going to want a separate account on your revenue for restricted versus unrestricted contributions. You just need to keep those separate. And you need a clear picture of expenditures and how they are being allocated and used across the different programs. And if they're coming from those restricted donations. So that needs to be shown on the statement of activities. When we're talking about reporting, we're also talking about compliance. Now, the first thing in compliance, especially as it relates to reporting, is generally accepted accounting principles. Nonprofits and all businesses have to follow generally accepted accounting principles in order to be consistent in our reporting for various reasons. GAAP has specific requirements for net assets, including how to classify it between restricted and unrestricted, when to record it, how to disclose it on your financial statements. But we also need to look at expectations of others other than just readers of our financial statements. And mainly those are the IRS and our donors. We need to keep in mind the expectations of the IRS and our donors. They want transparent and accurate reporting of our net assets. This reassures our donors that their funds are being used appropriately, and it keeps us in compliance with regulatory requirements. And another thing we may want to consider is an annual audit. And I'm talking about an annual financial audit by an independent CPA. This is often recommended. Sometimes it's even required, especially if you have governmental sourced income. Any income that comes to you that the original source was from the federal government falls under the requirements for a single audit act. So if you reach a certain level of federal dollars, you are required to have an audit. But audits are great in that they help us verify the accuracy of our net assets. That's one of the big things that we do in an audit is our net asset roll forward. We take our beginning net assets by classification. We add to it the contributions. We subtract what we released from restriction, and we come up with our ending balance. And the audit helps us go through that process and make sure that what's reported on our financial statements is accurate. So let's talk about a really simple example. Say your organization receives a $50,000 grant, and it's restricted for educational programs only. So we have a donation with a restricted purpose. So how do we account for it? When the contract is signed, and sometimes that grant money comes up front or it comes later, the actual entries are going to be a debit to your cash or your grants receivable for the amount of the grant. We're also going to credit our restricted contribution revenue. But we're not done. We need to debit our net assets without donor restriction for the same amount and credit net assets with donor restriction. Because what we're doing is we're moving that grant amount from without to with donor restriction. Because when net income closes into our net assets at the end of the year, it's going to close into the without donor restriction. And we want to reflect that balance. So we've got 4 line items in our entries: debit to our cash, credit to revenue, debit to net assets without restriction, credit to net assets with restriction. So that's the initial signing of the grant. Now, as we're expending funds and we're meeting those conditions, we're going to release the restricted funds. We may be, in our example, paying for staff or purchasing materials. We're going to release those restricted funds to cover those expenses. And we're moving them from the restricted pot to the unrestricted pot in our financial statements, and thus accurately reflecting that these funds are no longer restricted, that they've been used by the donor's requirements and their intended manner. Yeah, you asked me, what is the journal entry? The first part's really easy, same as every other expense. We're going to debit our expense account, whether that be salaries or supplies purchases. We're going to credit our cash account or accounts payable, depending upon if you use cash or you're running it through your payable system. Then we're going to debit our net assets with donor restriction. This is reducing that net asset with donor restriction to show that we're using that money. And then we're going to credit an account that we call release from restriction. And this is a quasi revenue. Sometimes we put it in other revenue. Sometimes we record it in the net asset section, but it's not, because this isn't revenue, it's a transfer. We don't want to include this as revenue in our accounts, or we're doubling the revenue. And this account is going to get closed into, if you put it in other revenue, it's going to get closed at the end of the year into our net assets without donor restrictions. So we want to keep it separate so we can see how much we're releasing during the year, but then we're going to close it out to our net assets without donor restrictions. So again, we're debiting expense, we're crediting cash, we're debiting net assets with donor restriction, reducing that number, and we are crediting our release from restriction, which is an unrestricted account. Let's talk about the importance of effective net asset management. Net assets are critical in determining the financial health of our organization. Our unrestricted to restricted net assets, that ratio lets us know how flexible we can be in our operations. If all of our money is in restricted, then we have to comply with those donor restrictions and those donor conditions because we've agreed to that. And we have very little flexibility in what we can do with those dollars. Where if we have a significant portion of unrestricted dollars, we can be more flexible in bringing on new programs. We can be more flexible with how we're purchasing new equipment we may need. We just have a lot more flexibility in what we can do as determined by the board and the strategic plan. Also, when we reflect these amounts accurately and timely, we increase donor confidence. They see that we are tracking their donations in a way that we're meeting the conditions of their expectations. And new donors see that as well. So that helps us build trust with our donors and ensure that they're comfortable with the impact that we are making based upon their donation. And they feel confident about ongoing support and even reaching out to new donors for us. And then finally, having this section accurately recorded helps us with our future planning. We know, do we need some more unrestricted dollars? Do we want to start a new program? Is there enough restricted dollars that this program would meet the needs of those restrictions? Can we do that? So when we're looking at our planning for this year and future years, it's very helpful information. So I just want to recap what we covered today. We talked about the two main types of net assets. Of course, they are with and without donor restriction. We talked about how we account for these, how they appear in the financial statements, and why it's so important to account for these properly for donor trust, for compliance issues, and just to show our organizational health, the financial health of our organizations. I want to thank you for joining me today. I hope you found this helpful. If you have any questions, please put them in the comments section below, or click on the chat function of our website at www.sandraraycpa.com. Once again, thank you for joining me, and remember that accurate net asset management is the backbone of the financial health and transparency of your nonprofit organization.